The top business stories live from the Sky News City studio. Consumer goods giant Unilever reveals plans to cut 7,500 jobs and spin off its ice cream business. I'll hear from one of the company's biggest shareholders and staunch critic, Terry Smith. The global era of negative interest rates comes to an end as the Bank of Japan tightens monetary policy for the first time since 2007. Plus, the global review platform Trustpilot swings into profit. I'll be joined by its chief executive. Good morning. This is Business Live with me, Ian King. The consumer goods giant Unilever said today it will spin off its ice cream business. The company, which is the world's biggest ice cream maker, owns 5 of the top 10 selling global ice cream brands, including Walls, Magnum and Ben & Jerry's. Unilever said it was confident that business would grow more strongly under a different ownership structure. It said a demerger was the likeliest separation route, but it would consider other options. Well, the news came as Unilever announced a programme aimed at improving its productivity. It said this will result in some 7,500 predominantly office-based jobs being cut from its global workforce of 138,000. The move follows criticism of Unilever's performance from its shareholders over several years. The shares this morning rose at 5% at the open. Well, in the last few minutes, I've been getting reaction from Unilever's 10th largest shareholder, Terry Smith, in the past a trenchant critic of the company. I began by asking him his reaction to the news this morning.
Positive, I would say. Why do I say that? We've heard two things. One is they are in some ways separating the ice cream business, and the other one is they're getting rid of 7,500 jobs. Right? Let's take them both. I think ice cream is a troubled category for them, so I can see why they might do that. It's not had any volume growth for quite a while, particularly in the at-home consumption area, and seems to have been prone to trading down stroke private label kind of competition, which is problematic, obviously, in inflationary times. So there's that. And of course, the ice cream's got the sort of fly in the ointment of the Ben & Jerry's situation, where prior management seem to have managed to buy a company without actually getting control over it, which is kind of interesting. So they've obviously got the rather serious spat with Ben & Jerry's overselling ice cream products in the West Bank, and that's obviously escalated with the Israeli-Hamas situation. So I can see why they want to think about getting rid of it. And if, and we don't know for sure, they go down the demerger route, that's pretty good as well, because we can make our own mind up then whether we want to own the ice cream business or not. Yeah, we sell them, and if we want to own more ice cream, we can buy more ice cream. So I think that's generally a positive, I would say, is my take on that. On the cutting of the jobs, yeah, good. One could stop almost there, but I won't, as ever. Why do I say that? If we go back to the Kraft Heinz bid situation, when you remember Kraft Heinz wanted to bid for Unilever and were seen off very early doors without ever actually really getting to put anything to shareholders. We weren't allowed the privilege of deciding what we wanted to do on it. And we're no fan of Kraft Heinz, by the way. We've never owned them, don't like the business model particularly, but still, you know, we'd like to have had the option to think about it. One of the things that was very striking was if you looked at the productivity of the Unilever situation, so any measure you like, the easiest one is sales revenue per employee, it was miles short of what Kraft Heinz was achieving. And it's kind of like one of those questions that if we had got to the point where there was a public debate with the shareholders involved about the merits of who should run the business going forward, that's something which might have got addressed, I think, and it didn't get addressed. And I think this plan is probably a consequence of it not getting addressed. My one criticism of the plan, I'll tell you, is as you'll know from our annual meeting, we did a bit of a resume of the history of Unilever and its management, and they've had several of these plans over time where they've said that they were going to leap forward with various funny names. The only thing I don't like about this plan is they've given it a name. They call it the Growth Action Plan. And that name falls foul of, well, first of all, my desire not to have clever sounding names at all, but also of a thing called Smith's Law, which, believe it or not, does exist. And Smith's Law is you should never say something or name something if you wouldn't say the opposite. So, for example, quite a lot of people say that they're going to make selective acquisitions, don't they? I've never seen anybody who said they were going to make indiscriminate acquisitions, although quite a few people seem to do it. They never actually said a growth action plan. Would you ever put out a shrinkage inaction plan? I don't think you would you? So I think great positive that they're addressing the very likely situation of having overmanning in the in the institution, and good luck to them. Basically, I think it's overall quite a positive. Yeah.
Yeah. As you say, I mean, they have had several strategic overhauls down the years, none of which really generated results. What makes you think it might be different this time? I mean, obviously, they've got a newish CEO at the helm.
Well, they've got a new CEO, they've got a new chairman, they've got a new CFO, they've got a new head of marketing. So they've had a bit of a clean sweep at the top. And notwithstanding my dislike of giving things names, they haven't come up with any things to throw at us in terms of targets for the future. They haven't sort of said, as a result of this, the margins are going to go to that, or the growth is going to move from this to this. But it basically just said what they're going to do, rather than outlining some quite probably spurious future targets as to what will occur. Because if you remember, the other thing that happened with the Kraft Heinz thing is we were given a bunch of targets in terms of margins and growth, none of which were attained, of course, not one. I mean, people get terribly excited about people naming targets. Hitting them is what we want to see. And actually, if things improve, if as a result of this, they get greater productivity, their growth accelerates because of the ice cream spin out, they get better margins and better returns on the business. I don't really care whether they go as a target or not. I'd just like to see what they achieve, you know?
Could they have gone further? I mean, there had been talk a while ago that they might demerge their entire food business, yet they're keeping this unit called Nutrition, which contains brands like Marmite and Hellmann's.
Yeah, on the whole, I'm not in favour of massive restructuring in terms of spinning things out or buying things either, for that matter, until you've got the business operating as it should. And so, we think that the first task of the new management, and it seemed to us they agreed, was to get each of the units that they've got, the nutritional food business, the household cleaning products, business with laundry and cleaning products in it, the personal care, health and beauty businesses, all benchmarked against their competition and performing as well as it's possible to perform within their sector. And I think once you've done that, then you can have a think about whether you should really be in food and nutrition, or whether you should be in over-the-counter healthcare and all these other sort of decisions which one could think of in life. But there didn't seem to us to be much point in doing it until you've proven that you can get the right kind of performance out of it. So we're not massively keen on doing that. Well, certainly at this stage, and possibly not at all. But we'd leave that until we see what they can produce, I think.
You kind of hinted at this in an earlier answer, but I mean, would you necessarily want to own shares in a standalone ice cream business?
I don't know, is the answer. I mean, ice cream has not been a bad product over many years. And although it's clearly faced some quite interesting headwinds during this inflationary period, when its input costs have been reasonably inflated, with things like chocolate or cocoa coming into it going up quite a lot in price. I don't know the extent to which those are temporary phenomena. Maybe it's going to be a decent-sized business. It's got the thick end of about 8 billion in sales. So it's not a small business. It's not as though one would dismiss it. So it's possible, yeah.
That was Terry Smith talking to me a little earlier. For more on that story, if you scan the QR code on your screen right now, you can read my analysis of how this move from Unilever's new chief executive is just what long-suffering shareholders have been urging. Bit of breaking news to bring you. This reaches in the last few minutes. Tesco has today lost an appeal in the Court of Appeal against a ruling that it infringed the copyright of Lidl. This relates to Tesco's use of a yellow circle on a square blue background. Lidl sued Tesco in 2020 on its use of that particular logo, which it's been using for its price match comparison club card prices discount scheme. They've been trading insults for quite a while, these two companies. The Court of Appeal has found today for Lidl. Now, the global era of negative interest rates finally came to an end today when the Bank of Japan raised interest rates for the first time since 2007. It's the world's last central bank to abandon negative interest rates. Others, including the European Central Bank, the Swiss National Bank and the Riksbank in Sweden, also introduced negative interest rates in response to deflation in the last decade, but have long since abandoned them. Well, the BOJ introduced negative interest rates in 2016. Its benchmark interest rate was minus 0.1% until today. That has been nudged higher to a range of 0 to 0.1%. Well, joining me now from Tokyo is Izumi Devalier, Head of Japan Economics at the Bank of America Global Research. Izumi, welcome to you. Why has the BOJ moved now?
Well, the Bank of Japan has been very patient in waiting for signs that Japan's domestic inflation pressures are sufficiently high to give it confidence that 2% inflation will be sustained. In that sense, they have been the opposite of developed market central banks who have been fighting inflation aggressively via rate hikes. In the Bank of Japan's view, the predominant issue over the past 2.5 decades is that inflation and expectations for wages have been too low. In fact, they've averaged around 0% in the pre-COVID, the pre-pandemic period. So it's been very patient in waiting for expectations to rise. Most recently, there are further signs of progress that indeed these expectations were changing. The biggest example is that in the ongoing annual spring wage negotiations, Japanese corporates announced that they would deliver average base pay hikes of 3.7%. Now, that might not sound a lot to those in other countries, but in Japan, this is the strongest pace of wage growth in 33 years. So the Bank of Japan today basically, acknowledged that progress. It declared partial victory on that 2% target and said, we're ready to move away from the most aggressive and most unconventional aspects of our monetary policy program. However, the key is overall, they're still keeping monetary policy easy. Again, we're talking about 0.1% interest rates. Considering where inflation is, real interest rates remain deeply negative, and the Bank of Japan's policy is still very easy.
Indeed, Izumi, they're still buying back government bonds, QE in the jargon.
Yes, indeed. And one of the focuses for this Bank of Japan meeting is that while the attention has been on the Bank of Japan's exit away from negative interest rate policy, keep in mind the Bank of Japan, as part of its very unconventional monetary policy framework, had been conducting what they call yield curve control. So not only did they set a target for the front-end interest rate at negative 0.1%, they had what they called a reference for the 10-year government bond yield at 1%. Today, as part of this overhaul of its extraordinary easing framework, the Bank of Japan also scrapped yield curve control. However, it has not really diminished its level of intervention in the JGB markets. They announced today that for the time being, they're going to maintain the same pace of JGB purchases, government bond purchases per month, which is still very aggressive relative to the supply out there.
Izumi, briefly, if you would be so kind, how are Japanese consumers and businesses going to respond to this? I mean, there's going to be a whole generation that have never known rising interest rates.
Yeah, so we don't think that this is going to be negative for sentiment. In many countries, if you hear about rate hikes, households start worrying about the impact on mortgage rates. Small enterprises and corporates start worrying about the rise in funding costs. One thing that the Bank of Japan has done very well is that it's spent a lot of time, in fact, probably the past 6 months, communicating and telegraphing this move very carefully. And in that process, they've underscored that this is not going to be a big tightening move. This is going to be a very incremental change in monetary policy settings. So overall, we think the negative impact will be very limited. If anything, the signaling effect of the Bank of Japan coming out and saying, something has changed for the better in the Japanese economy may even have a positive impact.
OK, Izumi, we have to leave it there, I'm afraid. Thank you very much for staying late in the office to speak to us. We do appreciate it.
Thank you very much for having me.
And there's much more on this story on the Sky News Money blog. If you scan the QR code on your screen right now, that will take you to our Money blog. Some other business news stories for you now. And the drug maker AstraZeneca said today it's buying the clinical stage biopharmaceutical company Fusion Pharmaceuticals for $2 billion. The move comes as the UK's biggest company looks to build its presence in cutting-edge cancer treatments. Fusion specialises in developing next-generation radioconjugates. Those are drugs that combine a radioactive isotope with a targeting agent that seeks out cancer cells and destroys them. The treatment is regarded as having the potential to revolutionise cancer care as it kills cancer cells in a more targeted way than traditional chemotherapy and spares healthy cells. The merchant bank Close Brothers today set out plans to bolster its capital position by up to £400 million. The move comes as the company braces itself for a major compensation bill linked to the Financial Conduct Authority's investigation of the historic selling of car loans. Close Brothers was reporting an operating profit before tax of £93.6 million for the 6 months to the end of January, which was down a fifth on the same period last year. The shares have actually risen 12% on today's news. And Crest Nicholson today became the latest house builder to warn it will build fewer homes this year than it did last year. The company, which specialises in homes in suburban areas in the home counties, said it expects to build between 1,800 and 2,000 homes in the current financial year, which runs to the end of October, compared with 2,020 last year. It also revealed it has become aware of build defects on 4 sites that were completed prior to 2019 that could cost it £15 million to fix, with remediation due to take place over the next 3 years. Now, Trustpilot has moved into profit on the back of growing use for its global reviews platform. The company, founded in 2007, reported a profit after tax for 2023 of $7.1 million. That compared with a loss of $14.6 million in 2022. Some 267 million reviews have now been placed on the platform. That's up 25% on this time last year. Well, joining me now is Adrian Blair. He's the Chief Executive of Trustpilot. Adrian, good to see you today. Were you looking to accelerate the move into profitability?
So I'm really encouraged actually by the results, and what I was saying to investors today is we're looking to steadily improve profitability over time as we realise what we call operating leverage, which is basically we're going to continue to grow, but we're going to increase costs at a slower rate than we're increasing revenue. But overall, as you say, really positive set of results today.
So what were the levers that you pulled to move the business back into the black?
So a couple of things. One is a lot more people are using Trustpilot to make decisions about where to buy. I don't know if you've used it yourself, but we've got 57 million average unique users throughout the year. The platform also gets huge reach through businesses, including us in their advertising. And we've got more and more business customers using us as well. I think the great thing is what CMOs are discovering is Trustpilot is a great way for them to drive growth.
Chief marketing officers.
Exactly. You know, we've seen Trustpilot being included in TV adverts, for example, and we've got some pretty good evidence now that that helps to drive sales for our customers.
Are there any particular product categories where you've seen stronger growth than others?
We've seen growth in high lifetime value consumer products, high lifetime value retail, financial services, insurance. But the amazing thing at Trustpilot is how the proposition applies right across verticals. And that's one of the unique things about us. We're this platform that, you know, whether you're buying a holiday or an insurance product or looking to move house and you want a home removals company, all of these different categories are covered at Trustpilot.
And what about geographic regions? I mean, it looks like you've grown pretty much everywhere. I know that there have been certain geographies that you've been targeting, like Italy, for example. Yeah,
what we've said today is, although we've got paying customers in more than 100 countries, so it's an incredibly global proposition, we're looking to be disciplined about where we focus our bets. And essentially the focus markets for 2024 are the UK, which is our biggest, the US, Germany and Italy.
You're fairly new to the business. What made you want to join Trustpilot?
So I've been a user of it for a long time. I've actually been a user on the business side as well. You might remember we spoke when I was back at Dext. We had a Trustpilot rating of 4.7 while I was there, which was something we were really proud of. So I've really admired Trustpilot from afar. When the opportunity came up to actually take over and take the business to the next level, I was really excited about it and jumped at the chance.
And of course, you're also at Just Eat. Are there lessons from there that you've been able to apply at Trustpilot?
So the bit that's relevant, and I was Chief Operating Officer for 7 years at Just Eat, is the way that we were really effective at building network effects. And that's what we see, you know, in spades in this business at Trustpilot. Basically, the more consumers use our product, the more useful it is to businesses. And the more businesses who are on there, the more useful it is to consumers. That's the kind of dynamic we had going at Just Eat as well. So, yeah, very relevant part of what I've done in the past.
Good stuff. Adrian, really busy day for your results day. We do appreciate you spending the time to chat today. Thank you.
Thanks very much, Ian.
Still to come here on Business Live, we'll be having a look at how the markets are doing this Tuesday morning. Stay with us.
I will always remember the atmosphere at the Shanghai protests. It was an electric mix of excitement, fear and defiance, and a sense that history was being made.
We beg you to let Madeleine come home.
My most memorable story was, and still is, the disappearance of Madeleine McCann.
I've seen people who believe and strive for the American dream, even in the face of disaster.
I'm David Blevins and I'm Sky's Senior Ireland Correspondent. I'm based in Belfast.
Traveling is not just about the destination. It's also about how you get there. Fly Emirates, fly better. Fly Emirates, fly better.
Well, stocks in the Asia-Pacific region had a largely downbeat session overnight, although I would draw your attention to the Nikkei in Tokyo, which, as you can see there, rose by 2/3 of 1%. Despite the BOJ's interest rate rise, I think that had been pretty largely priced in. Well, in Europe, this is how stocks are trading this morning, largely to the upside. Only the DAX letting the side down right now. Talking points today include the French software firm Atos. That's down 20% after Airbus abandoned plans to buy its cybersecurity unit. Well, here in London, the FTSE 100 is currently off by 1/5 of 1% right now. The leading gainer in percentage terms, you'll be unsurprised to learn, is Unilever. Currently, I think, up some 3% right now on news of today's acquisition, 3.5%. To the downside, AstraZeneca off just over 1% on today's acquisition news. Outside the FTSE, Trustpilot is ahead by some 2.5% after reporting a move into the black, speaking to the CEO obviously a little earlier in the programme. To the downside, Crest Nicholson off nearly 11% on that trading update. On the foreign exchange markets, well, the US dollar is up ahead of tomorrow night's decision from the US Federal Reserve, sterling off by 1/4 of 1% against the greenback, and the euro off by just over 1/5 of 1% against the dollar. As for the oil price, that's given back some of its gains over the last few sessions. Over the last 24 hours, barrel of Brent crude will currently cost you $86.86 a barrel. That's more or less unchanged, actually. Well, joining me now is Guy Ellison. He's head of listed securities at Investec Wealth. Guy, great to see you this morning. Lots of corporate news around Close Brothers. Obviously, a lot of people interested in what they had to say today.
Yes, you highlighted Close Brothers at the top of the show being one of the bigger movers on the day, up nearly 10%. It's a bit of a relief bounce in Close Brothers. The shares are still down by more than half year to date, and this all follows the FCA's review into discretionary commission arrangements. These are a scheme that was banned in 2021, so these are legacy products whereby motor dealers could, within a certain range, set the interest rate that consumers paid for their motor loans, and those motor dealers received a commission based on where the interest rate was, so potentially a conflict of interest there. Close Brothers was active in this market. It didn't dominate. You know, the usual UK household banking names, Lloyds, Barclays, Santander, had the lion's share, but as part of Close's banking business, this was not insignificant.
Yeah.
And
I understand, though, they've yet to make a provision against this, I think. Is that right?
Yes, they haven't formally put an amount aside as to where they think the liability could be. I think partly they're waiting to see how their individual claims stack up for them as a business. Other peers within the industry, we saw Lloyds a couple of weeks ago set aside $450 million as their provision level there. There have been various broker estimates as to what the impact on Close Brothers could be. We've seen those between 225 million and 350 million. Quite significant in the context of a business whose market capitalisation is around £500 million. But Close have also announced several measures to bolster their capital position, giving them plenty of firepower to pay any compensation should it come due. That included, slightly surprisingly, abandoning the dividend completely. They announced that back in February. That saves them about £100 million per year of cash flow. And they've announced today steps that could raise another £300 million or so of capital, should they need that, in order to cover any payments as they come due.
OK, now the other big story of the day is, apart from Unilever, of course, is AstraZeneca. What do you make of this acquisition?
Yeah, another seemingly very sensible bolt-on acquisition from AstraZeneca. We say bolt-on, even though it's several $1 billion in the context of AstraZeneca's £150 billion market capitalisation. You know, these are not dial-moving deals, but we had a similar announcement from them just a week or so ago as well, another similarly sized acquisition. Yeah, we'd encourage that. You know, this is active deployment of shareholder capital into those areas and fields where Astra thinks the growth opportunity is greatest. A bit like, you know, the inverse of Unilever's disposal today. Companies only have a finite amount of capital to deploy. We want them to be using that to pursue the greatest, you know, cash flow generating opportunities that they can. And Astra thinks they've highlighted another one.
And obviously they have that fantastic cancer business to step up with here. Guy, got to leave it there, I'm afraid. Good to see you this morning. Thank you. That's it from me. What a busy morning it's been. I'll be back at 4:30 this afternoon for our afternoon edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it will be Jane Secker. Thanks for joining me today. See you later on. Cheerio.